We're going to be talking about the collateral performance for unsecured consumer loans and buy now, pay later. We're actually surprised this is the last panel because we think performance drives everything, and we're going to talk about our distinguished panelists' views about what they're looking at and what trends they're seeing. My name is Güneş Kulalagil. I run the structured finance group at Stout. We do very simple two things. We value esoteric illiquid assets, which all of the products that we're going to discuss today, whether they're financed by a hedge fund or put into a securitization, are illiquid level 3 assets that whoever holds it needs to be valued. So that's one thing we do. The other thing is we do loan transaction advisory business, meaning when there's a funding gap between fintech, non-bank, specialty finance lenders who are looking to originate product, but they're looking for financing, we help them find that. Without further ado, I want our panelists to do a quick introduction of themselves, and we're going to jump right into the topic. So, Holly, would you like to go first?
Sure. Hi. Holly Reddington. I'm at KBRA. I work in the ABS group with a focus on consumer ABS. In our group, we're rating transactions in a variety of consumer asset classes, including auto loan, unsecured consumer debt, credit cards, solar loans, and the like. So that's a little bit about me.
Vadim Verhoglad, Head of Research across products at DV01. We're a marketplace data, analytics, market intelligence, and all things consumer and mortgage related for the structured credit industry.
I'm a big fan of both platforms, by the way. I've been using DV01 data forever, and I've been reading KBR, research, pre-sale reports. I'm big fan of both, and pretty good lineup because you're looking at the same asset class from different perspectives, or maybe different originators, different issuers, and things like that. Holly's world, obviously, there's billions and billions that are securitized, so you're seeing things from, not just a data perspective, but talking to originator servicers, so maybe a different, things you're looking at. And Vadim, you're obviously deep in the trenches of, data and data science, so that's a different perspective maybe, but also you're not only looking at securitizations, but private deals that house your data too.
Correct.
So with that, question number one, as it says on the slide right here, what is the collateral performance trends that you're seeing? We hear things aren't all that good. What are you looking at? Delinquencies, defaults, cumulative losses, what are the trends that you're seeing? Vadim, let's start with you.
Sure. The one thing that's important in this sector is you can guarantee to never be off the sidelines if performance is getting worse, because for every 10 basis point increase in non-payments, you're going to get at least 10 articles saying the sky is falling and the sector is going to collapse. But the truth is, what's happening is we're seeing performance deteriorate, but it's very much range-bound and it's very much targeted in certain market segments. It's really delineated well by a measure of ability to pay, or willingness to pay rather, with things like loan grade and credit scores being massive differentiators of performance, even more so than ability to pay metrics like income. And what you've seen is, because of this rapid credit cycle that the sector's had over the past 3 years, you've seen a rapid credit tightening in response to rapid credit loosening in 21 throughout the course of 22. And that's already began to manifest in performance. So while we did see rapid deterioration in 21 in vintages, we've seen big pickup in 2022. And the general strength of consumer credit, which we can outline by the fact that mortgage delinquencies just hit their all-time record lows last month, is the fact that consumer median incomes hit record highs in 21. We're seeing very sustained growth in consumer home ownership, record wealth levels among lower income consumers, and there's various points to be very excited about how the consumer overall is performing. And generally speaking, that's the trends we're seeing. On a macro level, we are seeing pockets of micro or sector underperformance, but really that is down to, number one, because it's linked to willingness to pay, it's something that's very easily to digest in terms of pricing because investors are fairly familiar with these concepts and they can adjust accordingly.
So Holly, Vadim is saying that yes, things were bad, but it is improving. Are you seeing those improvements too, or is it still sustained deterioration in your view?
Yeah, actually, when we were talking earlier, we were kind of comparing notes, and I think Vadim and I have somewhat of a different perspective on performance of of this asset class. And, as a rating agency, we are looking, we're certainly looking at the performance of the asset-backed securities. We're looking at the underlying collateral data. And in fact, we've got, at KBRA, we do keep a marketplace consumer loan ABS indices that we take a look at too. And so, just for comparison purposes, I did take a look at some of the numbers, and I don't want to throw out a bunch of statistics, but we have what we call it's tier 2. It's a prime, not a super prime, but a prime-based indices that contains loss data from about 8 to 10 prominent issuers where the underlying collateral is unsecured consumer loans. And so for the most recent March 2023 reports, we're looking actually at, and this is an annualized net loss rate of about 18%. Now again, I want to caveat this with, this is also largely dependent upon who's making up that index, and collateral does change depending on who's issuing and at what time, so it's not always a constant basket, but that number in and of itself compares to 11% pre-pandemic. So, that's a fairly significant increase. I think similarly, we're seeing the same type or same magnitude in the delinquencies as well. And again, these are as of March remittance reports, and so it's fairly real time, kind of this increase that we're seeing. And so I think that may be some cause for concern, because this is all against the backdrop, as Vadim said, there has been credit tightening in this asset class. And so despite that, there is, and I think in terms of timing, we saw it second half of 2022. And so, maybe that hasn't, made its way through the performance yet, but, I think that trend is, somewhat of a an alarming trend maybe. And just from a macro perspective, that is also against the backdrop of a strong jobs market and what people consider to be strong balance sheets, even though those balance sheets may in fact be elevated with high home prices and high home valuations and maybe inflated asset prices as well. I'm just maybe suggesting that while that balance sheet may look strong on paper, the liquidity portion may not be as strong for the consumer.
So deteriorating performance, but some light at the end of the tunnel, I guess, the takeaway from this first question. But this asset class, this sector has been likened to canary in the coal mine, this little weak bird that dies at the first sign of distress. And it's been 10, 15 years, and the criticism has been this is an untested asset class that hasn't seen a cycle yet. And we all thought, hey, during the pandemic, talk about a credit cycle, right? Literally that was a shock. But at the same time, we've seen stimulus payments and things like that. The performance actually improved, right? So, Vadim, I want to start with you. Has this asset class actually seen a cycle now?
No, it hasn't seen a cycle. It's seen 3 in the past 7 years. It had its own self-inflicted one in 2015, 2016. It had a fully externally inflicted one in 2020. It's got a bit of mix of both right now. Each time, the sector, the important thing about it, the sector was very quick to adjust. They were very quick to rebalance what they're originating. They were really quick to rebalance who the loan buyer base is. Both investors and issuers were quick to both get in front of, issuers would sacrifice loan volumes in the sense of improving credit and focusing on collections. Investor profiles would change. Some investors would leave, some others would enter as different yield profiles were engaged. So the rapidity of how the sector changes is one of its durabilities, but the most important thing is that a lot of the same participants that were lending back then are still lending today. So it's really not a fintech startup world anymore. We now have entities that have been lending for 2 decades with multiple experiences and cycles, and we've seen some of that same response. So I completely don't disagree with what Holly was saying. There is definitely some losses in that tier 2 space, and that's really key because a lot of that is linked to that willingness to pay. And certainly in an innovation environment like we have today, you are going to see some borrowers that are a little bit less attached to the loans because it's so rapid, because it's such an economically uncertain time. That said, we do see the way that the sector adjusts, how they're quickly able to pivot in terms of both taking lower origination volumes, but also really curtailing that risky part of the credit segment. And as that makes its way into the securitization markets, as we start to see some of those new production loans securitized, and also very importantly, as we see the buyer base change because of all the banking issues we've had, we're also going to see a very different profile type of loan begin to emerge in both securitized markets and in investor portfolios over the course of 2023, as we have through the course of 22, where the sector, quite frankly, in response to what was a mix of a self-inflicted and an inflation crisis, tightened lending standards at the fastest rate that it's ever done as an institutional asset class.
I think that's one benefit the sector has. This isn't a 10-year product, right? You can really react and adjust things really fast. Holly, I mean, you've been rating the same originators, issuers for years. I would think you agree that this isn't the first rodeo either, right? I mean,
yeah, I mean, I agree that the sector as a whole has been through a credit cycle. But I think maybe where Vadim and I differ is I don't necessarily think that the pandemic was what we would consider a classic credit cycle or classic, economic cycle. There were shocks to the system with, that sudden job loss, the $5 trillion of stimulus that went into the economy, rates at 0% for 2 years, followed by another shock of, what we've seen over the last 12 to 18 months in terms of now the interest rates rising. So I don't really consider that to be a true credit cycle. And I actually think really what's happening is we might be starting at the beginning of a new credit cycle, because that, and I think we'll probably get to this in the next question, is what else is going to happen? And I think clearly that answer is the jobs market, and what impact is that going to have on the performance in this sector?
I like it when panelists don't really agree on everything eye to eye. So I mean that's really the reality of our market, because there's so many different issuers, different perspectives, different people looking at different data from different perspectives, and simple as that. So we want to talk about what's next. So okay, we've seen a few cycles. We're in one. Maybe the credit cycle is playing itself out. What is different this time compared to the last few cycles that this market has seen in your view, Vadim?
There's quite a few things different. While the sector's been in 3 cycles, it's never been in a rate hiking cycle like this, but quite frankly, almost no sector has been. So in a lot of ways, what's different is, I think Holly's straight on to the point, unemployment can rise, and the question has always been, how does this sector respond? So some of the naysayers in this sector have always said that the credit performance will be much worse than unemployment by a multiple factor, and it won't be the one-to-one relationship we're used to in credit cards. That's not what happened during COVID, and despite the fact that there were several times during COVID when stimulus ended where somebody was screaming, okay, now this sector is going to fall off a cliff, and it never did. So if this sector is able to stay in that credit card kind of type range, or even a slightly higher multiple than credit cards, then quite frankly, the return profiles that investors have, and the fact that they're looking at a fairly short duration, pretty cash flow positive return profile, has the ability to take on an additional 150 basis points of losses if we have unemployment that's relatively stable. And if unemployment is much worse than that, then we're talking about a cross-sector product problem and a cross-market problem that is going to span well beyond consumer unsecured loans. The other thing that's different is obviously the prepaid profiles today are very different, because consumers are also far more educated than they have been before, and they're thinking about their entirety of their balance sheet. They're thinking about their net worth profiles. They're thinking about how are they prepaying all of their loans. They're much more judicious with their money, and we've seen that throughout 2020, 2021. We didn't see them reach into their home equity all that substantially in order to fund their lifestyle. We've seen them be very diligent about maintaining, their low interest rate mortgage, and we've even seen them do that with the consumer unsecured and maintaining, the low interest loan that they got in 2021 on the top grades. And on the bottom grades, we've seen that credit curtailment, eliminate the ability of kind of the move up prepay, where the bottom grade borrower makes 6 months of payments, their credit score resets, and they immediately kind of tap into a new loan. That's not really the behavior we're seeing. So in a lot of ways, we've already seen a massive set of tightening as investors and market participants and issuers are readying themselves for further economic challenges. So we don't know what we don't know, but I think the sector is positioning itself to kind of withstand some quite substantial shocks.
I think that's a good segue, withstanding quite substantial shocks from a ratings perspective. What are your thoughts in terms of, the new deals that you're looking at? What has changed in the structures? We talked about industry adapting to, these shocks. What are you seeing differently that's an improvement or a protection for the investors?
I think because this asset class has gone through economic cycles, it was around during the Great Financial Crisis. So there is, a historical precedent for the magnitude of losses during these ups and downs, in the economic cycle. So I think as far as, the rating agency perspective is concerned, is just continued vigilance with performance, to keep watching it, and to kind of see, I think the kind of the stresses that rating agencies use, I think they're applicable now. I think they will continue to be applicable until, we see something different. But, for the time being, I think they're where they should be, and they're, right on the mark. So, I can't say that there's really anything different that we are doing as a rating agency. We're just kind of going through the same process that we always do. But I do think because the situation itself is so different this time with respect to what the consumer is having to deal with, that it could manifest itself in different ways over the course of the next 12 to 18 months. We know the consumer is under stress, but will the jobs market, will that just kind of continue that stress at the same level just for a longer period of time? Or will we really see a major downturn and then an increase again? So I don't think we know exactly what it looks like, how that's going to manifest itself and what it will look like over the next year or so.
Speaking of over the next year, we have a question.
Yeah. May I add one thing?
Please.
I think the one thing that's very important in this sector is that what it's enabled that hadn't really been existing before the financial crisis is the significant expansion of data that is available to everybody that is tracking this sector. That data is becoming more and more important, and the fact that this sector doesn't have to hang its hat on FICO score and just on a metric that is standardized, but you get really hundreds, if not thousands, of attributes that you can really delve into the borrower and their financial situation, is one thing that's really powerful, because it allows everybody to really understand what kind of borrower they're getting in front of and what the perspective and what that borrower's, I guess, attachment to loan is.
I think that's one thing we can agree. The timeliness and depth of data is just the most important thing. And by the way, not relying on FICO alone, which is a great, gauge for certain things, but not relying that FICO alone is even more important now, because there's this concept of FICO inflation, especially throughout the pandemic, as people received stimulus payments and paid down loans and FICO's improved, and that wasn't an organic improvement, right? So I do want to take this question real quick. What do you believe is the reason behind the rise in delinquencies over the past 2 to 3 quarters, given unemployment is at record lows? And this is something we're head scratcher for us too a little bit, but
Sure. Yeah, I can talk about that. I think one of the reasons is the fact that the consumer has a job, but real wages are declining, and they've been declining over the last 12 months. So that's an issue. And while real wages are declining, we're seeing inflation, we're seeing the cost of gas and groceries going up, we're seeing rent go up, we're seeing maybe other forms of debt go up, maybe not mortgages necessarily, but maybe student loans, credit card, APRs on credit cards are reaching very high levels. So the consumer is faced with these other stresses in their monthly payments that I think is what's causing ultimately the delinquencies in this asset class.
Makes sense. Inflation, obviously, higher rates, higher cost to service, other debt. And potentially more of an impact on subprime borrowers than prime. That's
Yeah.
common sense also. Another question: do you think that the current collection solutions allow lenders to optimize the use of their data? Vadim, what do you think? Data and collection solutions.
I think we've seen the use of optimizing the use of their data is kind of a misnomer in this space because they've made so much data available. It's not necessarily a question of whether issuers are optimizing their data sources, but as our stakeholders optimizing all the data that they're getting. I do think that in terms of the collections processes, we are seeing that lenders are very dynamic in their outreach program, in their customer communication program. We saw this on full display during COVID, where everybody announced a modification program or a payment deferral program within days and weeks, rather than the months and years that we saw post-2008 in the mortgage market. So I think people are being as judicious as they can be with their data and with the limitations that exist on that data and collections and utility, because we do have to remember a lot of people in this sector are doing the right thing and are doing self-regulation and are not kind of crossing the bounds of PII or data that they shouldn't be using.
Perfect. We'll leave on that doing the right thing note. We're out of time. Thank you for joining us. Any questions, please let us know. Please reach out to us. Obviously, this topic is very near and dear to our hearts. We'll be happy to discuss further. Thank you.